Sir Rajesh sir is joining.
Hello.
Yes, sir.
Yeah. Good evening, everyone. I see Ajinkya Randive, Secretary Pune Branch. Welcome you all on today's seminar. It's a great pleasure to have Vaibhav Sankla with us today. I would like to give a brief introduction of our today's speaker. He is a founder, Billion Base Camp. He started with his career with PwC and then worked for several companies in India and abroad. He started a personal tax company, Adroit, which was later acquired by H&R Block. Over 20 years experience in taxation and personal finance. Most recently served as the managing director of H&R Block, the world's largest individual tax preparation company. Has been a personal financial advisor to a number of CEOs, CXOs, and HNIs in India and abroad. Often quoted in leading financial media such as the Economic Times, Mint, Money Control, etc. Sir, it's really a pleasure to have you today over here on the International Tax Refresher course. And I guess then we will hand over to you and we'll start with the topic Indian income tax and issues on non-resident individuals. So, sir, I hand over to you then.
Thank you so much, Ajinkya. Thanks, Rajesh, for the opportunity. Good evening, everyone, and welcome to this session on taxation of non-resident individuals. What we will do is we will first understand who is a non-resident and then how the different categories of income gets taxed in the hands of non-residents. Yeah. So, who is a non-resident? I remember a very good definition of a non-resident, which is a non-resident is a person who has planned his taxes well. I think some of you will be able to relate with this definition because, as advisors, we come across situations sometimes where a person becomes a resident of India just for a couple of days, just for a few days. And if he had managed it well, if he had taken your advice, during the financial year, the client would have probably saved, large sums of money, sometimes, millions of rupees, sometimes crores of rupees. So it is important that the clients understand the importance of planning residency, especially in the years when they are moving in or moving out of India. Coming to the tax law definition, anyone who is in India for less than 60 days, straight away non-resident. Very easy, right? Then what if the person is in India for more than 60 days? More than 60 days, but less than 182 days. And so the first is less than 60 days in India, straight away non-resident. The second one is 60 days or more in India, but less than 182 days in India in that year, but less than 365 days in preceding 4 years. Even in that case, he becomes a non-resident. Now, in certain cases, for Indian citizen, an individual becomes a non-resident of India, even if he spends more than 60 days in India, but less than 182 days, even if his stay in India during prior 4 years exceeds 365. So let's take a normal example, like someone who has always lived in India, he gets a job opportunity outside of India, he's an Indian citizen. Now, as long as in the year when he leaves India for the purposes of employment outside of India, he spends less than 182 days in India, he would be considered as a non-resident. And the last criteria is for Indian citizens as well as persons of Indian origin who are visiting India. They are considered as non-residents if their total stay in India is less than 182 days. Now, this 182 days rule for the Indian citizens or PIOs visiting India is reduced to 120 days if their Indian income is more than 15 lakh rupees. Now, we are going to talk more on these deeming provisions introduced in 2020 Finance Act, which became applicable from AY 21-22. So this is for those who are non-residents visiting India. A non-resident visiting India would be considered as a non-resident as long as his total stay in India in the year is less than 182 days. However, if he has Indian income of more than 15 lakhs, then he will be considered as a non-resident as long as his total stay in India is less than 120 days. And lastly, if an Indian citizen is a global non-resident, he is not a tax resident of any of the countries, then also he will be considered as a resident of India. Now, one thing to note here, which is very important. So if a person becomes a resident due to deeming provisions introduced in the by the Finance Act 2020, in all such cases, he becomes a not ordinarily resident of India. And as you know, practically in most cases, not ordinarily resident is at par with non-resident. Both of them typically pay taxes in India only on the Indian income. Right. So this is about who is a non-resident. I would emphasize that all of us should educate our clients, especially those who are planning to move in or planning to move out, about the importance of managing the dates or their stay in India in a way that they can actually become non-residents in the transition year, right? I do think that there is a very common misconception that the default rule is 182 days. The default rule is not really 182 days. So there is 182 days rule, and then there is a rule of 60 days. A lot of individuals become resident because of the 60-day rule, 60 days or more and 365 days or more in the preceding 4 financial year. So don't ignore that. 182 days rule is only for 2 situations. All right. Now, there's a treaty definition of a resident, and sometimes what happens is an individual is considered as a resident of 2 countries, and then what really happens? All right. So we have a tax law definition of a resident. Then we also have a treaty definition of a resident. And if you are a resident under the Indian tax laws and you're also a resident under the tax treaty, things are easy. If you are a non-resident under the tax law, but a resident under trade tax treaty or vice versa, then you have to really see, how you would want to go about it. So first is the treaty definition, or if someone is a resident or a non-resident under a tax treaty. Let's say someone is a non-resident under the tax treaty, but a resident under the domestic tax law, then he would be considered a non-resident only for the purposes of application of the provisions of the tax treaty, of that specific tax treaty. But you are going to file his tax return as a resident because under the domestic tax law, he is a tax resident. Let me explain how. So let's say a person is a resident of India under the tax law. He is a non-resident of India under a tax treaty. And he may also be a resident of India under another tax treaty, right? Because one can actually be getting covered under multiple tax treaties if he has, incomes from different countries. So the treaty residential status would be restricted to the interpretation of those specific tax treaties. Other than that, his Indian tax return will be a resident tax return, and the income which is not covered by any of the tax treaties would be taxed as if he's a resident. Now there is another thing. If an individual becomes a tax resident of both the countries under the tax treaty, then there's a tiebreaker rule, and under the tiebreaker rule of the tax treaty, he would ultimately be considered as a resident of only one of the countries to the treaty and not both the countries. The reason for that is the tax treaty can be interpreted for an individual only if he's a resident of one country and non-resident of other country. If he's a resident of both the countries or a non-resident of both the countries, if he's non-resident of both the countries, then he's not covered by the tax treaty, because the very foundational basis for the tax treaty is the tax treaties are applicable only to persons who are residents of either of the countries. So if someone is not a resident of either of the countries, then he is not covered under the tax treaty. So he cannot take shelter of the tax treaty at all. If he is a resident of both the countries to a tax treaty, then you have to apply the tiebreaker rule of the treaty. And then with that, he would be a resident of one of the countries and a non-resident of the other country. And then you interpret the tax treaty clauses for that individual. What we would do is, if you have any questions, I would suggest that you can post those on the chat box here. And then towards the end, we'll cover all the questions together. Now, for a non-residents, what we are going to do is we are going to see how different types of incomes get taxed in the hands of non-residents. I think one very common source of income for non-residents is capital gains. So non-residents, typically an individual becomes non-resident, typically to make more money, save more money, and whatever you save, you invest, right? And when you invest with an intention to make more money, and often, you make income in the form of capital gains with the investments you make as a non-resident. So you would see a lot of individuals owning properties in India. And whenever a non-resident sells a property, there are seemingly complex tax issues. So we'll talk about those. Then non-residents can also have income, capital gains, not just from sale of properties, but they can also have capital gains from sale of, let's say, shares, sale of mutual funds, etc. And shares and mutual funds, I mean shares of Indian companies or mutual funds, the Indian mutual funds. Right. So first rule is, I would say, don't get overwhelmed. Taxation is similar to what it is for a resident. By and large, taxation of capital gains for a non-resident is similar to what it is for a resident. However, there are some differences, right? One is the long-term capital gain on sale of unlisted shares are taxed at 10% for non-resident. For residents, sale of unlisted shares, tax rate is 20%. Like LTCG, tax rate is 20% plus applicable surcharge and cess. Then this is not really a difference, but just more like a clarification. NRI are not are eligible for reinvestment related deductions under section 54F, 54 and 54 EC. However, reinvestment in agricultural property, that benefit is not available to non-residents because under FEMA, non-residents cannot acquire agricultural property, right? So always keep in mind that if a non-resident is buying a property, say no, he cannot. If a non-resident is selling an agricultural property, also say whether he acquired that property when he was a resident or he acquired it under inheritance, or if he had acquired it under a gift or he had purchased it while he was non-resident, then there could be serious FEMA implications. So a non-resident buying agricultural property, definitely no. Selling the agricultural property, try to get to the root, the source. Did he acquire the property when he was a resident? If not, we have to really see whether he was permitted to acquire the property. Then there are special rates under Chapter 12A. Right. So typically, the capital gains, long-term capital gains for a non-resident who has made investments in shares of Indian companies or debentures of, I would say, debentures of a company other than a private company would get taxed only at the rate of 10%. Another difference is the buyers are required to withhold taxes or deduct taxes at source under section 195. So this is another very important rule. We often see instances where our clients are buying properties, sometimes even shares of unlisted companies from non-resident sellers, and then they have to obtain TAN and sometimes apply for lower TDS certificate and get the compliances done under section 195. So non-resident selling a capital asset typically attracts TDS under section 195. Now, few more important points. Special attention to the double tax avoidance agreements. Now, in all the DTAs, there is an article on capital gains. Typically, the capital gains article in the tax treaty provides that the gains from sale of immovable properties and even the gains on sale of shares of an Indian company, of course, can be taxed in India for a non-resident. So if a non-resident is selling an immovable property or shares of an Indian company, almost invariably there is a tax incidence in India and there is no shelter under the tax treaties. However, there are some treaties, one with Singapore, where, for example, one with Singapore, where I think shares acquired before April 2017, those are grandfathered. So anyone, let's say, with a taxpayer who is a resident of Singapore, he holds shares in an Indian company, he sells the shares, there is a very large capital gain, and under the India-Singapore tax treaty, the capital gains on sale of such shares are not taxable in India if the shares were acquired before April 2017. But barring such couple of such examples, typically India has retained its right to tax the gains on sale of shares of an Indian company if the seller is a non-resident. Now, the last point is important. Some DTAs, in fact, good number of DTAs restrict India from taxing gains from sale of other assets, so other than shares and immovable properties. So, for example, the tax treaty between India and UAE, tax treaty between India and Malaysia, tax treaty between India and Indonesia, and there'll be many more, I'm sure. India and Ireland. So there is a residuary clause in the article on capital gains. So what does the residuary clause says? Gains on alienation from any other property would be taxed only in the state of which the taxpayer is a resident, right? So it means that if you're a resident of UAE or Ireland or Indonesia, Malaysia, or any such country, and let's say you have made gains on sale of, let's say, mutual funds in India, right? The gains can be short-term or long-term because the clause doesn't differentiate between those. It is only about capital gains, not long-term or short-term, right? So if a non-resident individual has made gains on sale of mutual funds and he's a resident of one of those countries wherein India's right to tax the gains from the other assets is restricted, then such gains are not taxable in India at all. And this is a very, very important point. This is also a very important point for making investment decisions for such individuals. And in my experience, I have seen that the awareness of this clause is very minimal. We have worked with families who have had like millions and millions of dollars of investments in mutual funds, and they were not aware of this beneficial clause in the tax treaty. So, so this is all what I have for capital gains. Please do continue to post your questions. Now, tax planning strategies, regarding capital gains. So one important aspect of tax planning for non-residents, always remember, is be mindful of the tax laws of the country of residence. You can do everything which you can imagine, right, to save India taxes, only later to realize that, oh, the taxpayer still has to pay the taxes in the country of his residence, and all your efforts in saving the taxes in India are like literally wasted, right? So I know of examples where clients or residents of, let's say, US or some other countries, they sold properties, they reinvested gains, sometimes in bonds, sometimes in other properties, thinking that they will not have to pay taxes, only later to realize that they still have a tax liability in the country of residence. So very, very important to know, be mindful of the tax implications in the country of residence. And in the country of residence, there can be different types of taxes, by the way. So one is income tax, right, which we generally can think of more easily. But in India, we have no gift tax, but in a lot of other countries, there is a gift tax. And the annual exemption thresholds are in many countries very, very small, just few thousand euros or a few $1,000 and so on. So if your tax planning strategy in India involves gifting of assets, sometimes you gift loss-making assets to someone who has made taxable gain so that he disposes of the loss-making asset and then uses that loss to offset against the gains. Or sometimes what you do is you gift the asset which is to be sold someone else in the family who already has brought forward losses or something like that, and then effectively not pay any taxes on the gains or pay much lower taxes on the gains. Of course, you have to be mindful of stamp duty if it involves immovable properties. Now, stamp duty can vary state to state depending on where the property is situated. Different states have different rates of taxes, stamp duty for gifts to family members. Also thinking about reinvestment, we already spoke about loss harvesting. I'll talk about loss harvesting. But yeah, coming back to gifting, always check if there are rules on or the tax laws on gifts received by the person resident in that country and gifts made by the person resident in that country, right? Both ways. Otherwise, you plan your taxes by way of family gifts and later only to realize that those gifts are taxed in the country of residence, then it is going to be counterproductive. Loss harvesting, for the same individual, we all know that, right? But again, you need to know that loss harvesting rules in other countries. For example, in US, there is something called wash sale rule. So if you sell an asset, book a loss on that asset, and you acquire that asset within 30 days, then the losses on the prior sale are ignored, right? So you might be able to save the India tax, but in US, he still has to pay taxes because that loss is not really recognized in the US law. And if the client is a resident of one of the countries in Middle East, I think they are also slowly introducing taxes even for individuals or countries like, let's say, Singapore or something. It's going to be much easier because these countries either do not have taxes on individuals as of now, or some of the countries do not have taxes on global income, etc. So with some countries, if the individual is a resident of certain countries where the tax laws are very, what I would say, beneficial in the sense they don't tax global income or they don't have any taxation on individuals, then you only need to focus on Indian taxes. Otherwise, we have to definitely give a lot of thought on the taxes in the country of residence, and often you have to work with their tax advisor in the country of residence. Now we'll go to the next one, which is property income. So property income, what I mean really is rental income. I think it's very, very similar to what it is for a resident. You have rental income minus property taxes minus ad hoc deduction for repairs and maintenance, and then you have interest on borrowed capital. So very, very similar. However, withholding, tenant is required to withhold income tax at source, irrespective of the tenant status. So even if the tenant is a salaried individual, he has to obtain TAN and withhold income tax every time he makes payment of rent, and then file quarterly TDS return, etc. So this part is much easier. Then we have interest and dividends. Now this is the interest and dividend part is a bit more interesting. So essentially, the non-residents have three options to offer such income for taxation. So one is the default option, which is like just go with the domestic tax law, right? That is slab rates. You apply slab rates, income up to 2,50,000 is not taxed at all, and then we have increasing tax rates. Non-residents can also claim deduction under section 80C and all that if they are under the old regime. So typically this works when the quantum of income is less. So if it is few lakh rupees of interest income, you might as well, keep life easy, simple, just go with the domestic tax law. Your tax is anyways going to be near zero. The second one is DTA rate. Now, all double tax avoidance agreements have a special rate. The rates can be anywhere from 5% to 25%, would vary country to country for interest as well as dividends. Some countries very surprisingly have negotiated very low rates. Of course, needless to say, but just to emphasize, we are talking about interest income earned in India by non-residents, right? So certain treaties have restricted India's right to tax such interest income or dividend income arising in India to as low as 5%, right? So always check the DTA rate, especially for those clients who have very large quantum of interest and dividend income. And there is another alternative, which is Chapter 12A rate. It is applicable if the investment is made using convertible foreign currency, and the investment is in specified assets. Then the non-resident can opt to get covered under Chapter 12A, and it has a rate of 20%. Note that DTA rate is generally a fully loaded rate, which includes cess and surcharge. The Chapter 12A rate, domestic tax law, those rates, you have to add the cess and surcharge. So as you can see, there are multiple options for taxpayers, and typically they can go with, depending on the quantum, and then depending on what is mentioned, what is available under DTA, they can pick and choose. Another aspect about interest income is for non-residents, interest on FCNR deposits and NRE account deposits, that interest is tax-free. So if the non-resident is a resident of a country which doesn't have taxation on global income, or it doesn't have a taxation system for individuals, like most Middle Eastern countries, then you have to just focus on how to optimize the India taxes, and especially on the interest, one can see if most of the income can be earned in NRE or FCNR accounts. I have a very interesting observation. So there are two types of accounts, bank accounts, NRO and NRE. The interest on NRO deposits is fully taxable in India, and it also suffers 30% TDS unless you claim a lower rate of the treaty. Interest on NRE is completely tax-free. FCNR, that is foreign currency deposits, are the interest on that is also tax-free for non-residents. So not very many individuals apparently know that they can move funds from NRO account to NRE account. There's a cap of about $1 million. Is a cap of exactly $1 million. So a non-resident can remit up to $1 million outside of India every year, up to $1 million. For residents under LRS, it is $250,000, right? $250,000. For non-residents, it is $1 million. Now, I remember, I think about 10, 11 years ago, what non-residents used to do, they used to, some, of course, some very smart ones, they would transfer funds from NRO to their bank account abroad, and then from their bank account abroad, they would transfer the funds back to their NRE account, because NRE account credits can be only very restricted credits, right? So, because it involved too much of transaction, right? You send money abroad and again get it back. I think about 11 or 12 years ago, RBI allowed or permitted transfer of funds from NRO accounts to NRE accounts within the overall limit of 1 million. So if you're already limited, let's say non-residents are already limited $400,000 abroad, from his NRO account, then he still has $600,000 which he can transfer from his NRO account to his NRE account, with the big difference that the interest on NRE accounts is completely tax-free in India, right? So if you have clients who are non-residents who have made NRO deposits, you can certainly recommend them to move from NRO deposits to NRE deposits and have it tax-free. FCNR deposits, I think lately the interest rates have gone up quite a bit. And again, the rates vary from banks to banks. But even a dollar deposit with banks in India can earn a very decent interest rate these days, and the clients can consider making dollar deposits with the bank in the form of the FCNR deposits, and again have tax-free income on such deposits, tax-free in India. Now, for those clients who live in countries which have taxation on global income, then it may not much matter whether they are having NRO deposits or NRE deposits, because anyways, they would be paying taxes in the country of residence, especially if they are in a high tax bracket in the country of residence. All right, so this was on interest and dividend. I will go to the next slide. Again, if you have any questions on interest and dividend, feel free to post your questions on the chat box. Salary income, right? One very foundational principle of international tax law, I would say, is salary is taxed in the country where the employee is physically present. That is a very core principle. Salary is taxed in the country. Now, it doesn't matter where the employer is located. What matters is where the employee is physically present. For example, if the employer is in India and the employee has always been out of India, and we have had some cases where a person was employed in India by the Indian company, getting his payslip in India, getting his salary credited in India, and getting his Form 16 in India. But the employee was almost entirely or for the entire year outside of India. So in such cases, the salary is taxed only in the country of residence and not in India. And in India, then you have to try to avoid the TDS by letting the employer know. But if you cannot, then you have to claim back the entire TDS as a refund. So salary is taxed in India only if it is earned in India. If the employees, it is considered to be earned in India if the employee is physically present in India, right? However, so think of someone, let's say an American company, I'm just saying, who comes to visit India and stays here for 60 days or multiple visits during the financial year. So what happens? So for those 60 days, he had actually worked in India. He was physically present in India. So does India tax that income for those 60 days? The answer is no, because there is a short stay exemption provided in most tax treaties, right? So if an employee of a non-Indian company comes to India, then the dependent personal services article, that is the article on salary income, really, it provides that if an employee of a non-Indian company comes to India and performs his services in India, then as long as his stay in India is less than 183 days, his income is not taxable. His salary is not taxable in India, right? And then there are other conditions that his employer should not have a P in India and the salary should not be borne by a resident of India. So that is typically the situation. All right. However, if, let's say, an expat comes to India, he is employed by an Indian company, right? A company registered in India, and let's say he spends just 3 months in India, right? Then that salary is not taxed. That salary is taxed in India, because the moment salary is paid by an Indian employer, the short stay exemption goes away. The moment the salary is paid by Indian employer, the short stay exemption goes away. And the salary becomes taxable in India, right? Then there are complexities which can arise if there are bonus payouts, there are stock options, right? I think we should discuss a bit about stock options. Typically, stock options are taxed, using what we call sourcing rules, right? So what you do is, during the vesting period, so vesting period is the date of grant to the date of vesting. During the vesting period, if the employee has worked for, let's say, 30% of the time in India, then that 30% portion would get taxed in India, even if that person later becomes non-resident, right? So let's say someone was working in India, he got grants, and then later he moves away to some other country, right? He becomes non-resident. Now he actually gets his stock options or his RSUs vested while he's a non-resident. So in such cases, to the extent the RSU, the value of the shares, what I would say is to the extent he performed his services during the vesting period in India, let's say 30% of the time, then that much portion of uh, the value of his ESOPs would get taxed in India, even if in the year of vesting, he's a non-resident. Right. So a very important point for globally mobile employees, especially those who are getting ESOPs, RSUs, etc. I'm just thinking there was one more point which I wanted to highlight on salary income. Yes, that is for teachers. So some tax treaties have a separate clause beyond dependent personal services. Dependent personal services is nothing but an article on taxation of salary income. But some treaties have additional clause on teachers or professors. So again, you have to check treaty by treaty, but I do remember just recently, in some cases, even if the employer is an Indian organization or institute, paying salary in India, like a resident individual, Indian resident company or institute is paying salary, to an expat or professor. I think it was India US tax treaty. So that salary is not taxed in India for a period of 2 years. So teachers, professors always check sometimes. So teachers, professors always check the treaty if there is a separate clause carved out in the treaty. Also always check, pension, and again, not all treaties will have a separate clause on pension, but many treaties would. And again, in pension, there are two categories: private pension and government pension. So do check the respective treaties and see how India would tax. Does India have right to tax it in first place, under the tax treaty? So this is about salary income. Now consulting income. Now we are talking about NRIs. This is individuals concerned income, not corporate income, right? So this is covered under the article on independent personal services. Independent personal services. So one option is, of course, you can offer it for taxation in India as if it is your normal Indian income, but you can claim treaty benefits. Under most treaties, it is taxed in India only if consultant has a fixed base available to him, right? Or his stay in India exceeds 90 days. Right. So for example, if your client is a company in India and it is making payment of consulting fees to an individual outside of India, right? In most cases, the TDS would be zero. In most cases, the clause relating to royalties and fees for technical services, because we are generally accustomed to refer to that clause, is not applicable because this is covered more specifically under independent personal services. If the services are provided by individual, then you typically have to go to independent personal services article. If the fees are paid to a corporation or a company abroad, then you go to the other clause. And as I mentioned, it gets taxed in India only if the person has spent more than 90 days in India or he has a fixed base available to him in India. Now we'll talk about other income. Now other income, what would it cover? I think we already spoke about pension. We spoke about teachers' remuneration. I think we have covered most kinds of income, but anything which is not really covered by any of those clauses would get covered under other income. Now, I'm just trying to find an example of other income, and I think one thing which comes to my mind really quickly is gifts. Gifts can fall in other income. So one, you can say you have the option to get covered under the domestic tax law, but under the domestic tax law, the gifts are taxable in India, or tax-free in India only if received from a relative defined under section 56, right? But if the gifts are not received from a resident, then those gifts are taxable. However, if the recipient of the gift, is a resident of certain countries where we have a tax treaty, and under the tax treaty, under the article for other income, which is really the residual clause of the treaty, any other income not dealt with in any of the other articles, it's taxed only in the country of which the person is a resident, right? So recently we had a client in UAE, and she received a very large amount of gift from someone who is a relative, but not within the definition of, not falling within the definition of relative under section 56. So fortunately, because she is a tax resident of UAE, and under the UAE tax treaty, other income is taxed only in the country of residence, right? We could escape the Indian income tax liability because of that clause, right? And not every DTA provides for or restricts India's taxation rights on other income. UAE, I know for sure it does restrict, but you have to again check country by country and see whether there is a specific clause on other income and how the other income is dealt with in that specific treaty. And if it restricts India's right to tax other income, then you would find opportunities to plan taxes for such individuals. So let me see what is there. Yeah, so some treaties restrict India's right to tax other income, and we just spoke about that. I think beyond all this, I would say that if you are working with a non-resident, largely just check what are the tax laws in the country of residence. If you're a resident of countries like US, life can be or life is going to be a bit complicated for sure. If he's a tax resident of a country like UAE or Singapore or some of the other Middle Eastern countries, the life is going to be much easier. Be aware of estate taxes. A lot of clients, they move to countries someone is going to UK, someone is going to US, someone is going to Germany and all that, they are not aware about this tax called estate tax. And estate tax, as you know, we had estate taxes in India abolished, I think in early 80s or something. Last several years, we have been hearing those murmurs of getting that reintroduced in India. So far, nothing has happened, right? But in most countries of the world, there is estate tax. The thresholds are very low. So in most countries, the estate taxes are applicable on global assets of the resident of those countries, right? In some countries, it is based on domicile, which is different than residency. Domicile is a bit more permanent, than residency. So if you are domiciled in another country or a resident, depending on the laws of that country, you are exposed to estate taxes in that country on global assets. These days, Indians are getting richer and richer, and it is not uncommon to have individuals with whatever $1 million+ of wealth, right? Very easily in many cases, and some cases, clients have a really large wealth, and they move to other countries and they don't realize that they have a significant estate tax exposure. So any client moving abroad, important that you make them aware, you learn, what could be the estate tax exposure, what are the gift tax rules, because when you are in India, you are generally free to make gifts to parents, gift to kids, spouse, and plan things around and do all that. When you move away, you become a resident of other countries, there are going to be a lot of restrictions. I think another aspect about non-residents, I would say, is non-residents currently do not have TCS on remittances. The TCS on remittance, currently 5%, going to be 20% very soon, is only on LRS. LRS is for resident individuals. A remittance from non-residents, they can remit up to $1 million a year. I would say sometimes some families can avoid TCS by making remittances through their non-resident family members. And I think even until 1st of July, we have a window wherein a resident can make a remittance, can make a transfer to his non-resident close relative or family members account in India, and then he can make the remittance outside of India without suffering the TCS. But from, I think, 1st July, even domestic transfer from a resident to a non-resident, so from a resident account to a non-resident account within India, that will get covered under TCS. So I think there is some window of opportunity available just on the TCS part. I would say that sometimes there are opportunities to plan taxes when a lot of families these days send their kids abroad for studies. And the kids become non-resident. There are opportunities to leverage the kids' non-resident status to plan taxes. In countries like US, those who are on student visa are considered as non-residents for 5 years. All right, so they are like not resident of India, not resident of US, for tax purposes. And there could be interesting opportunities to plan taxes there as well. So yeah, I think I am actually done. It's what 6:10. We have time. Okay, we have one more topic. Sorry, tax residency certificate. The importance of TRC. Uh, the importance of TRC is that if you want to claim treaty benefits, as I mentioned at the very beginning, the tax treaty benefits are available only if you're a resident of either of the countries. All right. If you are not a resident of India, then you have to be a resident. If you are not a resident of India, then you have to be a resident of that other country to the treaty. Otherwise, you are not covered under the treaty, right? So to substantiate that you are actually covered under treaty, and when you're saying you're already non-resident of India, then you have to be a resident of the other country. So you have to obtain tax residency certificate, which shows that, okay, you are a resident to one of the countries to a treaty, and basis that you are claiming the benefits under that treaty, right? And TRC helps you substantiate that. In terms of procedures, the TRC is required to be uploaded along with the tax return and form, the newly introduced form 10F. And some also remember that some countries take much longer time to issue TRC. Sometimes month, 2 months. So it is really, really very important to apply for TRC early. Don't start thinking of applying for TRC in July or whenever you are closer to the due date of tax filing. So apply for TRC, identify those clients who are going to claim tax free benefits, right? And get that done sooner. Be mindful of cost for applying for TRC. Some countries have it free, I believe, and some countries it can cost some significant sums. So you have to find that trade-off. So it should not, the cost of TRC should not be more than the tax benefits or tax exemptions you are going to claim under a treaty, right? So yeah. So thank you so much, everyone. I really enjoyed this discussion. I hope you did too. And what I'll do is I'll take up some questions one by one. Okay. So 531. Did I miss some? I remember looking at. Okay. Can NR get basic exemption limit in capital gains? Excellent question from Rupesh. The non-residents do get basic exemption limit on short-term capital gains, but not on long-term capital gains, right? So short-term capital gains, which are taxed at normal rates, there is basic exemption. The long-term capital gains, there is no basic exemption. In last slide, NR includes PIO, NRI in context of capital gains. So this is from Chetan. Just trying to understand. See, when I say non-residents, that is non-resident under the tax law in the context of taxation of capital gains. Non-residents, now that non-resident can be any non-resident, not necessarily non-resident Indian or a PIO. Actually, I'm just thinking the definition of NRI under FEMA actually includes a PIO who doesn't live in India. Jayesh, if Indian company posts employee out of India for a particular period for 182 or more days in a previous year, pay salary in INR and deposit in Indian, then what is the tax liability whether it changes if the employer deposit to a foreign country employee account? Okay, excellent question. So Jayesh had this question. Indian company employee is outside of India for more than 182 days. So employee is a non-resident. That's what he meant. And the salary is paid in Indian rupees in India. Then whether there will be a tax liability and whether it will change whether the if the employer deposits the salary into a foreign country, into a bank account in foreign country. So as we have seen, if an individual is a non-resident, then he has to pay taxes in India only on salary earned in India. That is during the period when he was physically in India. Now, let's assume in this case, for the sake of simplicity, Jayesh, the employee was always outside of India, like entire year. Then what really happens is there is no tax liability in India, first of all, because he's a non-resident and did not spend time in India at all. Now, this is assuming that we have a tax treaty with that country, all right? Because what is the general rule? Income earned or received in India, right? So the income is earned outside of India, but received in India, it would be taxed under the domestic tax law. However, if the employee is in a country with which we have a tax treaty, then under the clause relating to the under the clause relating to dependent personal services, he would say that the salary is taxable only in the country of which he is a resident, and then not taxable in India at all, right? I'm just thinking, if the country where the employee is residing does not have a tax treaty with India, then the salary received in India will be taxed in India, even though the employee is outside of India. So whether the payment is made to the bank account in India or the bank account outside of India, that would matter depending on whether we have a tax treaty with that country or not. How to apply TRC in other countries? This is question from Akshay. So Akshay, process varies country to country. Every country has a different process. Some countries it is much easier, simpler. Some countries it is more extensive and you have to take help from a professional there. What is a tiebreaker? Yes, what is a tiebreaker rule in case of a resident as per the treaty and law? So there is no concept of a tiebreaker rule in domestic tax law. All right. The tiebreaker rule for residency is only in the tax treaties. Now, this is question from Satish. So what happens is, it is possible that an individual becomes a resident of two countries in a financial year, right? One, because the tax residency rules are different in different countries. And sometimes also because of the fact that the tax years are also different in different countries. India has a fiscal year, April to March. Some countries have calendar year and so on. So because of this, a person may become a resident under the domestic tax laws of two different countries. And typically what the tax treaty says is, if you are a resident of both the countries, then like there are 3 or 4 tiebreaker rules. The first rule is typically, you are considered as a resident of the country where you have a permanent home available to you. Now, if you have permanent home available to you to the available in both the countries or in neither of the countries, then you typically look at closer economic and social ties or center of vital interest, and then you look at the nationality, and I think there is one more. So basically, the treaty would have all the three or four tiebreaker rules, in the order, right? So you have to see the specific treaty and check, sir. What if TRC is not received till due date of filing return? As I said, it is best to avoid the problem. I think for this year you have time for sure, and you can apply now, and I think nearly in every country you will get a residency certificate, for last year for sure. In case of deemed resident provision, how come income of 15 lakhs will be, whether it is only taxable income? Yeah, you should consider only the taxable income, Murli. Manoj, how tax residency determined under DTA? Which article can you please? Oh, so basically tax treaty doesn't define the residency as such. So I'll tell you how the tax treaty typically is worded. So a person is considered as a resident of, let's say, India, if he is liable to tax therein, by the reason of his, domicile, stay, etc., etc. So it doesn't really. So if you are a resident under the domestic law tax laws of India, you would be resident under the tax treaty. So basically, it is that. The only thing is, if you are considered as a resident of both the countries, then treaty provides you with a a tiebreaker rule. We have questions from. Okay, we have a good number of questions. So Manoj, I think how tax residency. Okay, we have several questions. So let me do this. Let me take you through a tax treaty and explain that. So Manoj, and I think there's one more person who asked that question. So Rajesh was a special rate under chapter 12A. If the person was a resident when he bought the stocks and is a non-resident now, will his capital gain eligible for concessional tax rate? So Rajesh, see, now this one is easier. But one important point is chapter 12A applies only if the investment in specified assets is made with convertible foreign currency. That is important, right? So when you are a resident, you are not going to make the investments in convertible foreign currency. But to your specific questions on stocks, listed stocks, long-term capital gains are anyways taxed at 10%, right? And unlisted stocks, again, capital gains are taxed at 10% only, under 112. So basically, it doesn't really matter. You don't have to worry about 12A as far as long-term capital gains are concerned. But otherwise, as a rule, you cannot claim benefit of 12A if the asset was not purchased with convertible foreign currency. Non-resident of US, NR. So Praveen Jain has this question. NR of US resident. Okay, non-resident who is a US resident. That's what I'm assuming. He meant who is also a PIO, sells his residential property and pays capital gains tax. Has he also to declare the same in US returns? Can he get credit of tax paid in India? Of course. So one, he has to declare the same in the US tax return for sure. If he's a US tax resident, and he will get credit of taxes paid in India. But I mean, I can talk a lot about US taxes. So US has 3 different taxes, all right, on capital gains. So one is income tax at federal level, then income tax at state level, and third is net investment income tax, NIIT. So the credit mechanism in US is available only against federal income tax. So if his federal income tax liability is, let's say, 20%, in India he has paid 25%, then he will get credit only to offset against his federal income tax. But he has to pay state income tax separately, he has to pay NIIT separately. All right. So important point. Employee working for a foreign company but under work from home arrangement, salaries created in foreign currency converted to rupees to his resident bank account. He was in India for more than 180 days in previous year. So the salary will be taxed. So this is from Rohit. Or is there any option to not tax it in India? Yeah. I mean, employee working for a foreign company under work from home arrangement, of course, there are separate, permanent establishment related issues, which I will skip for this discussion. Let's focus on the employee. If the employee is in India for more than 180 days, if he's a resident in India, then he has to pay taxes on his global income, right? Now, what he can do is he can avoid taxes maybe by two ways possibly. One is if he becomes a non-resident of India, right? And I'm not sure whether he can claim the benefit of that 182 days rule. He has to really substantiate that he is living in India for the purposes of employment outside of India. Right. So if as long as he can substantiate that, and then he can be in India for less than 182 days and be non-resident, and then avoid at least partially tax liability in India. Another option could be to incorporate a company in other country where there is super low taxation, and then get the money as consulting fees in that company, and the POEM rules are typically kicked in if the turnover is 50 crores. So I'm assuming the income is less than 50 crores. So there are ways he can plan. There are some ways he can plan, reduce the taxes partially or maybe in some cases fully. If Indian company posts employee out of Indian for a particular, so I think we have talked about this, Jayesh. Jigar Karya, what is the impact of no provisions leading to gifts to non-resident by a resident Indian? Will it be taxed in India as deemed income? Yeah, I mean, see, gifts to residents, gifts received from relatives are going to be exempt. The new provisions do not impact that. Gifts received from relatives are tax-free. What it impacts is gift from non-relative. Now, gift from non-relatives were taxable. However, if the recipient is a resident of a country, and if that country, we have a DTA, and under that DTA, India's right to tax other income is restricted, then there is an escape route. Otherwise, gifts to non-residents by Indian resident to a non-relative non-resident are going to be taxed. Rajas, US citizen who is now a resident in India gets social security allowance from US government. Since SSA is exempt from tax in India due to DTA position, would it make a difference if SSA is created to Indian resident? No. If an income is exempt, it is not taxable in India under DTA, then it won't make a difference if it is created to Indian account or a US bank account. It doesn't matter. I think from administrative perspective, I think it would be easier if he received in the US bank account and then remits it back to Indian account. Just from administrative perspective, I think I don't know how easy it is for the social security authorities in US to kind of make that transfer to a non-US bank account. But if it can happen easily, no worries. as far as strictly from tax perspective, if income is exempt under DTA, then it doesn't matter whether you're receiving it in an Indian bank account or a US bank account. It doesn't matter at all. The buyer anonymous, the buyer is buying immovable property from a non-resident. If the seller does not apply for lower deduction certificate, what will be the applicable TDS rate, 20% or 30%? Does the buyer has power to classify if the gain is long-term or short-term capital gain? Yeah, I mean, this is bit tricky. Strictly speaking, under section 195, taxes have to be withheld. What is taxable is income, and so you have to calculate the income portion, and if when you calculate the income portion, you would also, of course, find out whether it is a long term or short term. If you want to play it safe for TDS purposes, you can withhold taxes, on the sale value, and not get into nitty-gritties of, what is the gain portion and indexation and all that. Does the buyer have, can the buyer classify it as long-term or short-term? Yes, as long as he has reasonable confidence, that, the documents, what he has, are the right ones. Typically in the agreement, you're going to have recitals about, how the prior owner acquired that property, when he acquired and all that. But even the buyer can apply for low reduction certificate. So I think the best would be to approach the tax authorities. The buyer can approach the tax authorities as well and apply for lower TDS rate. And typically you can get, depending on the situation, but you can get something as low as 0.5% or 1% and of the sale value. So try that. If you want to play really super safe, then sale value and 30%. Jigar Korea, what will be the status of parents visiting children living abroad for more than 10 months every year? Parents visiting children living abroad. So more than 10 months they are visiting. So basically less than 60 days in India. So they don't have to worry. So they are not resident of India. They will be non-resident. But if they are considered as non-resident of the other country as well, if they are considered as non-resident of other country as well, then they would become deemed resident, right? If their income in India is more than 15 lakhs. But you don't have to worry much, because even those deemed residents are NOR, so that they have to pay taxes in India only on the Indian income. I think what I would say is more important here, Jigar, is you have to understand their potential tax liability in the country where they are visiting, right? If it is like US, Canada, I don't know, Australia, or some country in Europe, they may have tax issues in the country of residence. So be mindful of that. NRI purchasing from other NRI, whether TDS is required to be deducted. Yes, the TDS is required even if the buyer is NRI. So the status of buyer doesn't matter. If the seller is NRI, then TDS rules are applicable. If yes, then purchasing NRI required to apply for TAN. And lastly, NRI seller can tax for low reduction. He can also invest and take benefits under section 54, 54F. Yes, the seller can take benefit of 54, 54F. I mentioned that before. And I am not fully clear about the rest of it, but I hope you got answers to your main questions. Can a non-resident who is also a PI gift immovable property to his relatives, say his own sister? And are there any issues with the income tax workings in India? Non-resident is filing IT returns in India on his Indian income. Yeah, PIO can gift immovable property to his relative. And I think that is one of the common tax planning strategies when a non-resident is selling a property in India, give the property to a resident, avoid the tedious issues, sometimes avoid the income tax in the country of residents as well. So possible, no issues at all. Yeah, so I hope, Praveen, you got answer to that question. What I will do now is I will share my screen and we'll just go through a tax treaty and see the definition of uh, resident quickly, and also the tiebreaker rule, like really super quickly. Just give me a tax treaties. I think I'll pull India US tax treaty. Yeah. IRS website. Yeah, can you see the share the screen? Yeah. Okay, all right. For the purposes of this convention, the resident of a contracting state means any person who, under the laws of that state, is liable to tax therein by the reason of his domicile, residence, citizenship, place of management. So basically, what the treaty says is a resident of a contracting state means a person who, under the laws of that state, is liable to tax therein by the reason of domiciles, residence, citizenship, or other criteria of similar nature. So it doesn't really define that, but only says that someone who is liable to tax in that country. And also remember that an RNOR is typically not considered as a resident under the tax treaty. Very important. In lot of treaties, okay, I think it can vary from treaty to treaty, but let me just see. Yeah, so there is, if you see A, however, that this term does not include any person who is liable to tax in that state in respect only of income from sources in that state, right? So because of this, typically an RNOR is not considered as a resident for treaty purposes, all right? And as we have seen, the treaty really takes you to the laws of that state, right? Who is liable to tax under the laws of that state by the reason of his domicile, residence, citizenship, etc. So what you really look at is the residency under the domestic tax laws of the respective country, for the tax treaty purposes. And if that person is a resident of both the countries, then you go to the tiebreaker rule. I think we can quickly see the tiebreaker rule. Here, this is US treaty. There is going to be different. So he shall be deemed to be a resident of the state in which he has a permanent home. I think we spoke about that. If he has a permanent home available to him in both states, then he will be considered to be a resident of the state with which his personal and economic relations are closer. Then we spoke about center of vital interest. Then there is habitual abode. And then lastly, then there is a national, and if it's a national of both the states or neither of them, then the competent authorities, shall settle the question by mutual agreement. Yeah. So great. I'm just thinking if there is Anything else? I think we have covered nearly all the questions. So thank you so much, everyone. Okay, we have some more questions here. We just got it. All right. So Manoj has asked this question, FTS and independent personal services clause. So typically independent personal services clause is for personal services, that is an individual providing services. So if individual is providing the service, don't go to FTS, go to independent personal services article. Rupesh, so Rupesh has mentioned, as discussed in CIT versus G India, TDS need to be deducted on net income amount only. If you can just give information how we can get the capital gain amount. I think you can get a CA certificate or something, which kind of certifies the capital gain calculation. I think that should be good enough in that case. Yeah, I think if you see mutual funds and brokerage, non-residents have PIS and non-PIS accounts, brokerage accounts when they invest in Indian listed stocks, or even mutual fund investments they make. Typically, the mutual funds or even the brokerage houses, they withhold the income tax only on the net amount. That is the actual capital gain, long-term, short-term, they calculate, and only on the actual gain amount they withhold income taxes. When a non-resident sells its listed shares or sells its mutual funds, the mutual funds and brokers deduct taxes. They actually calculate the gain and withhold taxes. Now, for them, it is generally easier because they have the cost details. When you are buying a property from non-resident, difficult to really have precise calculations, because there could be whatever expenses relating, there could be additional items, but I think you can still do high level calculations. As I said earlier, in most agreements you are going to have recitals about how the prior owner acquired the property and all that. So you can take a CA certificate and yeah. Can you use this for immovable property also? Yes, you can use this for immovable property also. Practically it can work, but as I said, not too difficult to get a lower TDS certificate. Even the buyer can apply for it. All right, so thank you so much, everyone, and thank you so much, Rajesh. Thank you so much, Ajinkya. And
sir, yes, I'm there, sir.
Hello.
Yes, sir.
Yes. So yeah, I think over to you, Rajesh. I'm done. Thanks so much, all the participants. I think very engaging. A lot of questions. Yeah.
I think the topic was also very open. That sort of taxation of non-resident is a very open topic and covered so many topics.
Yep.
Thanks a lot, Vaibhav. On behalf of Pune branch, I really thank you for accepting our invitation and enlighten all the participants, and also had very good discussion, active discussion. Also thanks to all the participants for your active participation, and really we will see your session on Pune branch in physical mode, sir. Thank you.
Sure, sir. Sure. Thank you. Thanks.
Thank you. Thank you.